Introducing the new DocsTradingPost.com, your online survival superstore for the lowest priced guns, ammunition, and optics available online. Prepare today at DocsTradingPost.com. This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us again this week is our good friend Alasdair Macleod from Gold Money. It's great to have you back, Alasdair.
It's lovely to be back, John.
Well, we're recording this on Thursday morning U.S. time, Thursday afternoon, evening London time, and we're seeing a bit of a bear squeeze here in the markets, which is a bit of a breath of relief for investors as well as anybody looking to source physical coins right now, as there's been a pretty significant shortage worsen or develop over the first half of this week. So why don't we start with the market action, the first half of the week and into today, and the squeeze we're seeing here today, Alasdair.
Well, the squeeze is really not on gold, but it's on virtually everything else. And silver, having had a very, very bad first half of the week, is recovering strongly today. I think as we speak, it's up about 40 cents. I don't know how much trade there is going on, but I would have thought that, yes, it is very much a bear squeeze. There are enormous short positions in the metal, and I think that given a fair wind, that bear squeeze should continue.
And what's your take, Alasdair? Why don't we discuss a little bit your piece that you've released here to end the week on what we've experienced in the overall markets. Is this the beginning of the next great financial crisis?
Well, it feels to me like it's the beginning of a global stock market, if you like, realignment. Call it a crash, if you like. I think a crash happens very, very quickly. I don't know, obviously, how quickly this is going to happen, but it feels to me like stage one, where you get that very nasty shock. It just wakes up everyone. It stops them short, and they begin to start worrying about capital preservation, if you like. And all the reasons for it are sort of blamed on external factors. I mean, at the moment, I think everybody's running around saying it's all China's fault. But what they're actually ignoring is that the underlying economic situation is one of building debt, and it's been building and building and building, certainly since the Bretton Woods Agreement, and more particularly, really, since the late 60s and early 70s. And the build-up of that debt has to have a terminal point. And so, economists like von Mises, the Austrian economist, always saw that it would end in tears. He always saw it would end eventually in something which he would call a crack-up boom, which was the last boom of the lot, which only occurs because people dump currency for goods because they realize that the currency is worthless. Now, we're a long way from that, but that is the eventual outcome of the situation which we have. And when you see a stock market crash, of course, it makes you think, I wonder if this time is going to lead to that situation. And it could well do, for the very simple reason that the one thing that the Fed learned from the Lehman crisis, which was the last crisis we had, was that you can print money in order to rescue the banking system and to ensure that debts are not called in. And you can lower interest rates. Now, they've lowered interest rates to zero. They've got stuck at zero, so they can't do that trick again. So it basically means that the only weapon they've got left to deal with deflation, whatever you like to call it, is the massive expansion of raw money. And they will indulge in that if they need to rescue the markets. And of course, we'll have to see whether they have to rescue the markets. All I'm saying is that what we have seen over the last 2 weeks is a very, very clear signal that things are not well. And after a brief rally, it is more than likely that a bear market will resume. And in that case, I think the Fed will have no option but to print money as fast as it can to try and prop up the system. But of course, propping up the system doesn't work because you can't buck the markets forever. And the eventual outcome must be the destruction of the currencies. So I think we are very close, if we're not actually at the point of this end game starting.
Alasdair, do you think the Fed is going to have to reverse course so severely that not only do they not raise rates, but they actually announce a new round of QE?
Yes, precisely. Raising rates, I always thought, was a bit of a nonsense. The Fed had got themselves into the position where they could see that they couldn't raise rates. So what they wanted to do, as much as possible, was to create an environment, if they possibly could, whereby they raise rates. I mean, the reason they can't raise rates is actually very, very simple. With the Fed funds rate at 0.25%, they have something like 2.6 trillion of excess reserves sitting, and this is the bank's money, sitting at that interest rate on the Fed's balance sheet. Now, if they raise rates, all they're going to do is they're going to attract more money out of the banks into the Fed's balance sheet. That's not what they want. It's completely the opposite of what they want. What they want is a more healthy lending environment where the banks actually withdraw excess reserves from the Fed's balance sheet and deploy it into the economy. So raising rates at this stage is just, it becomes so self-defeating that it wasn't going to happen. And I think that the Fed, sort of jawboning about raising rates in September or whenever, was really just trying to set the scene where they could possibly just get away with it. But it's not going to happen. And I think that the effects of the Chinese devaluation, the numbers that are coming out of China, the fact that China is so obviously in a deflating credit bubble, basically rules out any possibility of a rise in interest rates in the United States, and it almost certainly guarantees that you're going to get the production of money, call it quantitative easing if you like, of the production of raw money in order to stop the US economy tanking along with all the others. And so I think actually that QE is becoming inevitable. It's a question of when rather than if.
Yeah, it's very clear, and although this jawboning and attempt to regain their credibility might result in them just going for one rate hike just for the heck of it, and then that would only exacerbate the stock market correction, and in fact speed up the time frame for any kind of QE going into next year. I think that's probably what we're facing. I've been operating on the assumption, even going back as far as the fourth quarter of last year, that we would possibly see one hike, but it's probably off the table at this point. I mean, officially, when you look at indicators from the futures market betting of market participants, it's now to, I think, like 34% expectation of September hike versus a month ago being at like 50 to 60% expectation. So, the market participants in our financial markets are shifting downward, and the Fed is facing this, and it's giving them a little bit more of a room to be able to backpedal given all of the financial turmoil, and maybe we won't see an interest rate hike. It'll be interesting to watch, but this whole hockey stick acceleration of debt capacity and debt load in the Western economies is nothing short of breathtaking, and we have to be in the end game of one form or another, and it really is just a matter of timing. I totally agree with you, Alasdair.
Yes, and I don't even see the if you like a sort of token rise in the Fed funds rate. I would quite happily rule that out. I just cannot envisage a circumstance. I mean, other than the Fed being just incredibly stupid, which I suppose we can't rule out. But these guys, I think, are frightened rather than stupid. That's the way I would put their dilemma.
The problem for the Fed, though, becomes, I mean, they're really backed into a corner because if they do not raise rates now, which, I mean, the market is kind of dictating that, I agree with you, Alasdair, I don't see how they're going to be able to, but the problem then becomes if they don't, they lose power, their jawboning power, which is really their main power. I mean, 0.25% rate means nothing compared to the last 18 months of jawboning about it. That's what's been moving the markets, is the threat of it. And they lose that credibility with the market when they've been jawboning about it so strongly for seems like eternity, and then they don't ever do it. They're going to lose a lot of power of talking the market.
Yeah, and part of what they've been able to achieve is this talking where the interest rates have fallen. The bond market participants and even the institutional, the pension funds, et cetera, have been willing to go out and buy bonds with the faith that the Fed, quote unquote, would have their back, and that we wouldn't see the interest rate curve get away from the Federal Reserve. But there's something coming that has been absent for probably a decade at this stage, and that's the bond vigilantes demanding real compensation for real risk. And then in this world where we've gone through this hockey stick acceleration of debt load, the ability for the Fed to pull the wool over everybody's eyes, or at least get participants to delay for another day in their mind the coming of the crack-up boom in currencies, but it also impacts the credit markets and the shadow banking market in particular. The realities are such that at some point the bond market's going to get religion, and people are going to demand a real-world economic relationship to bond holding, as opposed to this fantasy land that we've been living in, where we went down as low as 400-year low long-term bond interest rates in Western economies. And I think that that's going to be the catalyst that creates the big one when it comes to the final reset of all of the financial assets and the equity market, leading it down in conjunction with bond market pressure, where right now we're going through a stock market correction, and if the Fed finds itself in a position where they're going to have to launch QE, there's enough people around that still believe in the magic potion of QE being able to levitate financial assets and spill out through the shadow banking system and keep things moving up, at least in the financial space of the economy versus the real economy. And I'm operating on the assumption that that's probably going to happen, because the Fed's going to be pushed there, and that'll set up 2016 for this kind of transition to reality by market participants instead of this illusionary game that people have been basically. It's almost like a crazy uncle who's abusing a family member in the upstairs bedroom, and no one wants to talk about it. There's this massive denial about what's going on in our credit markets and what it means, and I think that that's probably going to change. And I state all this stuff in preface of the question to Alasdair. I think I'd love to know what you think about that in terms of what could happen in 2016 or whenever, when people finally get religion and come to reality when it comes to credit markets, because for the longest time we've been living in a fantasy world.
I think where I would start with addressing these points is by putting forward a proposition, and that is that macroeconomics, as we understand it today, is actually a load of hogwash. Its starting point, in terms of application anyway, is to deny Say's law, deny the laws of the markets, deny the law whereby you and I go and exercise our various skills for money in order to earn something so that we can spend it on the things that we want. This is what everybody does. Everybody's different. They've got different skills, different skill levels. And if they are employable, and unless somebody's going to give them money so that they don't have to go out and work, everybody is employable. That is the law of the market. And you put some money aside for future consumption, and that's called saving. What money is in this relationship between production and consumption is its stored labor. Now, that is the point which all modern macroeconomics denies completely. So they think they can monkey around with your stored labor to produce a better result. You can't. The laws of the markets are basically sacrosanct. So we have a situation where you've got all these very clever guys who've come out of Harvard, who have been taught macroeconomics, and now have the problem that they're learning that what they were taught actually doesn't work, and they have got nowhere to turn to. It's a very difficult situation for them. They also have the problem that the politicians are telling them, look, we can't allow the banks to go bust. We can't allow the consumers to be worse off. We can't allow this. We can't allow that. So the political imperative is on top of this and runs completely against any return towards sound money. They don't even understand sound money, by the way. But this is the problem that I think all government macroeconomic specialists, including central bankers, have. They do not understand what they're doing. They do not understand basic economic theory. And we are now beginning to find that out. So all they can do is fly by the seat of their pants. All they know is that when the next crisis hits, and I would suggest that it's not very far away, and it's probably going to be in the form of widening corporate debt spreads and falling stock market prices, not right now, but maybe in a month's time, what they will do is they will go back to what they know works. They will go back to the Lehman crisis, and they know that they put out $13 trillion worth of guarantees and money and managed to stop the banking system from falling over, managed to stop the derivatives markets from imploding. They will do exactly the same thing. And next time, if it takes 30 trillion, not 13 trillion, they will make it available. I have no doubt about that whatsoever. Now, this raises the next question that follows on from that. This complete abandonment of any sense of value for money right from the top will inevitably lead, after whatever pause, I don't know, to questions being asked in the minds of the public about what is the value of our currency. Now, if the public get the idea that actually all this paper stuff that the government produces is worthless and there is no point in holding it because we will lose money, then you will get the crack up boom. They will dump it for whatever they can buy. Now, it could happen very quickly. If you go back to 1920, 1923 in Germany, basically it was a cash economy. What they had to do was they had to print the physical notes in order to deliver that in the form of wages, whatever, to people who were earning something in order to spend. And this time it's different. This time it's electronic, it's instant. So you don't have the delay, if you like, of the printing presses having to run 24 hours a day. I think they had 7 large printing presses running 24 hours a day under Rudolf Habenstein, who was the head of the Reichsbank at that time, the president of the Reichsbank. And this time, it's easy. You just move money electronically. So that could mean that the collapse in the currency happens far more rapidly than when the physical transfer of paper money was really required and was the backbone of how things were bought and sold. So this situation, I think, is very, very serious, and it could catch up on the central bankers a lot more rapidly than anybody thinks. So all in all, we do have this problem. They don't understand what they're doing. They only know that the last attempt to rescue the economy from crisis, the Lehman crisis, worked. And so they will, just on the basis of that experience, repeat exactly the same medicine. But next time round, it'll have to be more. And next time round, I think that it will take the crisis from an economic crisis to a banking crisis to a currency crisis.
Yeah, I agree with that, and I'd only add that halfway through the next time of QE, I believe that we are going to see financial market participants second guess the quality of credit and realize that, yes, we've gone through now what they would be calling at that stage QE4, and being much larger as well, most likely, that the very confidence in the debt that forms the credit fiat-based currency system in our world will begin to unravel. The people already understand, in my opinion, and I cannot prove this, but it is my educated opinion based on reading a whole heck of a lot of financial news and interviews and so forth, that a very large percentage of the conventional finance world, in terms of money managers and portfolio managers, pension funds, etc., understand that this debt pile that we have been building is unsustainable and that it ultimately will kill itself because it will implode on itself. You cannot have something that goes parabolically higher and higher indefinitely. And I believe that QE4 is sometime in the process of QE4 unfolding. People are going to begin to understand that and act upon it, as opposed to understanding it now as a risk factor. And central bankers are always going to be able to cover the mess that they make and have our back and so forth. And that, unfortunately, or fortunately, depending on how you look at it, I mean, that is what's going to create what everyone right now is fearing is going to happen this fall. That is the crash of crashes, the Great Depression style crash that equals or exceeds 2008, 2009, something like that. I think the missing ingredient that we haven't had is this final transition of the faith amongst people who deal in the credit markets. Because, and in particular in the United States, we have the benefit of, still having the reserve currency status and people looking at the United States crazily enough in the bond market that we have as a safe haven. And this is the missing ingredient. I'm thoroughly convinced at this stage that this dynamic is what's going to define how we move into the next, other than a 20% down correction / mini bear market initial stage. So, Alasdair, you actually described what we're talking about. Coming in this quarter is maybe even just an initial phase of what we're seeing right now as being the initial phase of a bigger market. And I agree with that. I just think that we're probably going to see QE save the day for a period of time and then everybody losing religion somewhere halfway through QE where people recognize this risk and the reality of the bond market rolling over. What do you think about that thesis?
Well, I think it makes sense, but I would add another thought to what we're discussing, and that is the whole purpose of debasing the currency will be to prevent a debt reconciliation, if you like, debtors meeting their creditors. Now, the whole point about printing money to achieve that end is that what you need to do is you need to debase the money. You need to debase its purchasing power. So this will become the unstated objective of policymakers. It is quite possible. I mean, we used to laugh at Bernanke's suggestion about helicoptering money. It is quite possible that there are people in the Fed who will see that as the final solution and even recommend it. And not helicopters as such, but the equivalent in terms of distributing money, because they don't understand money.
Actually.
I'm sorry?
I mean, back in George Bush's day, we had a very small example. I believe it was $800 or something. It was a tax rebate that went directly to every citizen in the United States.
That is
true. And they could just do something like that on a massive scale, or just issue electronic debit cards or whatever.
Yes. Well, what worries me is they don't actually understand how prices work. If they did understand, they wouldn't have thrown over Say's law for a start. But if they don't understand how prices work, then helicoptering money, if I can use that as a phrase, is a very, very dangerous thing to do, because it would immediately trigger price inflation, which would set in motion the sort of stagflation which we experienced in the 1970s. And what you would then have is a situation where the market forces the Fed to raise interest rates, not the other way round. The Fed would lose control over interest rates. And with that happening, of course, you then got a real crisis. So the idea that you can actually debase the currency to alleviate the debt burden on over-leveraged companies, on the government, and on over-borrowed consumers, that starts going out of the window, because you have to raise interest rates, and nominal rates are going to kill everybody very, very quickly if they rise beyond more than 1 or 2%. So I think that they have got themselves into a hole from which there is no way they can escape other than meet reality and do what I think probably the Chinese are going to be forced to do over their stock market, just stand back and let it happen. But the Fed are not going to do that, because we have a democracy. We have something that we call a democracy, and the central bankers in the welfare-driven nations do have a political responsibility. I know they say they're independent from politics, but actually, at the end of the day, they're all appointed by politicians. They have to respond to the political demands of the day. And when you get a crisis, there is no doubt in my mind that the central banks have to toe the political line. And that's going to happen.
Yeah, and with the banking assets or the balance sheets of banks being impaired by the falling of financial assets, they also have that incentive as well too, because their ultimate masters are the bankers. And in the United States, Congress can theoretically challenge the charter of the Federal Reserve and repeal it and move money back into the function of the Treasury and the issuance of direct credit, as opposed to this weird game that we have in the United States, all justified on the theory of, we want central banks to have independence, when independence is a complete illusion anyway.
Absolutely, but I really do think that the people in the Fed have a real problem. They're not, they're not bringing out QE and this sort of policy and that sort of policy just to rescue the banks, which a lot of the cynics say is the case. I mean, the banks are the only channel they know for distributing, sort of, if you like, fiat currency into the system, because most of it's credit apart from anything else. So they need to help the banks in order to keep that going. I just think that they've got themselves into this end game position where they cannot really see any exit. They are in a very difficult position, and it was inevitable. They're going to have to. The only way out of this, as I see it, is to debauch the currency, and they need to do that in order to alleviate the debt burden. And let me put it this way: it's the debt burden relative to the collateral, the value of the collateral that secures it. So asset prices must be encouraged to rise again, and in any event, they must be discouraged from falling, which is what we have got, what we have seen in the stock market over the last 2 weeks, and we've also seen in corporate bond spreads. Their bonds have been falling in price. So the whole thing is something which is actually quite difficult for them to rescue, but they have got to rescue it.
I want to give the listeners a quick update on the state of the physical markets and gold and silver here in the U.S., and really particularly with silver being down, about 5% the first half of the week before the bit of the bear squeeze we're seeing today here on Thursday. The physical market has just gone nuts this week. We were already seeing signs of shortage, really across everything, is just exploded, and we've really seen the beginning of a run on silver this week as physical demand has just gone through the roof. The Sunshine Mint new orders they're estimating to ship around early November timeframe, and again we're still technically in August here. We're in the summer months. The U.S. Mint cut allocations or production this week by about 70% from what the previous few weeks' allocations have been, which was a big surprise to the market. And we've seen Silver Eagle premiums explode over the past 24 to 48 hours. A couple of the biggest online precious metal dealers are nearly about $6 over spot now for under a tube or tube quantity, and they're about $4.50 over spot for the largest quantity of a box plus. And I mean, it really has only been a week or two ago where, while the market was tight, we weren't seeing those types of premiums. Really, all the private mints are now probably about between 4 and 8 weeks out on production, and really it's turning into a scramble to find anything live available. This morning we had a shipment of 10-ounce Sunshine bars come in, and just anything that comes in that we list is available in stock, not on a delay. It's just instantly snapped up, and I mean, all the authorized dealers and the wholesalers are saying the same thing. It's beginning to get out of hand. The head of the trade desk, yesterday afternoon, I was speaking with the head of the trade desk of one of the largest authorized dealers and wholesalers here in the U.S., and he told me that they've been raising prices and extending delays pretty much by the hour yesterday, and his quote was, "We just can't get people to stop buying silver no matter what we do. We just can't get them to stop buying." And we've been seeing the same thing on the retail end. We have had a bit of a respite here today with spot prices jumping about 40 or 50 cents. I remarked yesterday, and I still believe if we do see any further price weakness really below that 14 level anytime in the next month, you will see premiums that look like what we saw in 2008. And we're already now looking at probably the biggest premiums we've seen since 2008, but they're going to be on par with that level if we get any further price weakness, because there's just no coins available, coins, bars, anything. There's nothing available on the market. I mean, you can't find any Johnson Matthey bars, you can't find any Sunshine bars, and we're talking about 100-ounce bars, which, I mean, typically, if I want to call up one of the wholesalers, I could buy 10,000 bars if I wanted, and now you can't get two.
That is interesting. I think when it comes to gold, I would be very surprised if the devaluations that we're seeing across Asia doesn't, if you like, spur demand for physical throughout Asia. I mean, already it's been running at historically record levels in China. India's demand has also picked up very substantially at these current prices. Turkey's currency has fallen about 4%, 5% this week. Turkey has a long and unfortunate history of a very weak currency. They knocked 6 zeros off the Turkish lira back, I think it was in 2004, which gives you an idea about the sort of the weakness that they've had and why, everything that's serious works in Turkey works on gold. Gold is Turkey is a very big gold center for that part of the world. Also, the Kazakh currency, the tenge, that fell over 25% at one stage this week. So you've got all these factors which I think are likely to encourage middle class demand and lower middle class demand for gold. I mean, if you're in China and you see the stock market crashing there, or anywhere in Southeast Asia, then I think it makes you frightened, if you like, for the value of paper currencies. So I think that's going to catch up with the futures markets, because I think that if that happens, then the idea that they can sort of gently move along and beg, borrow, and steal the physical from wherever, then they're not even going to get that. The shortages could really become very, very acute, particularly if they insist on keeping the price of gold down at this current level.
Yeah.
I think if I can say something about that, of course, we have every right to suspect that the exchange stabilization funds around the world are trying to keep the price of gold down. They are authorized to do this, and indeed it is very much in their remit when it comes to managing currencies, also to manage the price of gold. I would not be surprised at all if the market is dirty, in the sense that you do have these government funds trying to manage the price as part of an overall package to keep overall confidence in asset markets together. Because if the price of gold suddenly rose, I think that that would have a very negative effect, and I think it would be seen to have a very negative effect on other markets. So all in all, it's an interesting situation. I think you've got, let's call it the establishment in the general sense, on one side of the equation, and you've got a lot of Asians and others around the world. I mean, even Americans picking up silver coins and bars, as you say. The ordinary person is beginning to realize that this is not a nice environment for his money, and therefore he needs a bit more protection. That's happening all around the world.
And servicing this Asian demand that's on the rise, we have frequently seen a lot of the indicators of that in terms of, say, for example, Swiss refineries running 24/7, 365, multiple shifts and whatnot. And we've talked about this before when we've had you on, and you've had a lot of very interesting insights from your contacts. Do you see anything interesting happening with respect to Swiss refiners these days, vis-a-vis the shift in the market, the recent declines in precious metals, and in fact, is there as much pressure in the refining system to service this Asian demand as we saw in previous periods? What do you think about where the refiners are today, and what market signal intelligence value they may be giving us?
Well, bullion is still going from west to east, and I think it's a question of availability now. In the past, there was always, a vault somewhere where gold could be leased. In other words, borrowed to be sold into the market, and then re-refined from 400-ounce bars into 1 kilo 49 bars. And that process is still continuing, though I think there's a lot that, there's not so much stock around at the moment, and it's from time to time it's very difficult to get anything to deliver into the markets. And I see that situation continuing and maybe even getting worse. I mean, so long as prices are suppressed at this level, it just doesn't make any sense at all from the point of view of the physical market, simply because it just all runs out. It just goes, and you end up with backwardations all over the place. I mean, that's been
Right.
such a feature of markets recently, and still is.
Yeah, why don't you speak a little bit about that and explain it to our listeners? A lot of people
Well,
are new to our show.
yes, a backwardation is something that shouldn't happen. I mean, if you think about gold, it's not just the amount of stuff that comes out of the mines, which is roughly 3,000 tons a year. There is also the above ground stocks, which, including jewellery and all the rest of it, total around about 165,000 tonnes. We reckon it's about that figure. I think if you go to the World Gold Council, they'll say it's about 175. So, but 10,000 tonnes on that amount is not going to make an awful lot of difference. The point is, there is a lot of stock above ground. Now, under those circumstances, obviously, you will have a spot price and you will have prices for future delivery. Now, what should happen is the difference between the spot price and prices for future delivery should reflect an interest rate differential. So your spot price should be slightly less than your future delivery price. What is happening is there is a shortage of physical in the market, so the spot price goes above the future price. And what then should happen is that people with stock should go into the market and say, we can correct this, we can make a profit selling physical and delivering physical for spot and buying it back in the future. But for one reason or another, that's not happening. And there are two possible reasons. One is that nobody trusts any of the counterparties in the market to do that sort of deal, which is possible. And the other is there just ain't any physical stock. So you can take your pick. But I can say from my point of view is probably a bit of both, in the sense that with the sort of, if you like, official stocks, we don't know what the official stocks are. I don't know there's a lot of trust in the market now. I think that for purely financial deals, I mean, there is no problem. If a hedge fund decides, we'll go into the London market and we'll buy some gold, and they will be encouraged to open an unallocated account with a bullion bank. Now, that means that the bullion bank doesn't actually have to go into the market and buy the gold. All they do is they credit the hedge fund's account with the equivalent of gold just purely in a book entry. So they don't actually have to physically own the gold. Now, as long as you can continue to play that game, you can sort of, have the stuff zinging round and round and round 50, 100 times without it actually having to stop anywhere. So it's rather like a juggling act, if you like. And that's what happens with the forward markets in London. But I think that's getting difficult. And as a result, the idea that there are people willing to take on the arbitrage and actually have the stock to deliver, I think that's not true. I don't think that the people have the stock to deliver, and I don't know that they would want to get involved in an arbitrage in something where they see the market actually isn't working properly in the first place.
Yeah, it's a great explanation. I think the confidence issue about whether or not somebody's going to get delivery is increasing as a factor behind the backwardation. I want to just toss out one quick footnote about this, because there are many people in our audience who believe that the above ground stocks of gold is an order of magnitude larger than what World Gold Council says, or what Alasdair just quoted as 165,000 metric tons. I mean, even if we had say the world has double of what those figures represent, that only makes the backwardation phenomenon all the more odd, because theoretically there would be more gold around, so people would have the confidence that delivery somehow, some way would be happening because of gold returning to the financial intermediation of LBMA, et cetera.
Yes, I would take the point. I think anyone who thinks that there is a considerably more gold around, they're sort of reading the Yamashita gold story and all the rest of it, which I think is
dragon families in China,
yes,
or so
exactly.
forth. I mean, there's probably a lot of truth in this too, but it's kind of irrelevant. Backwardation is happening, and the fact that that extra gold is here, if it is here, it would be all the more reason to not see backwardation.
It's a load. It's a load of baloney, I think. We've actually, if you go onto the Gold Money website and hit the research tab, you will find that under there, under white papers, James Turk did a very detailed analysis of the above ground gold stocks, going back as far as he could. I mean, basically, the numbers start from the time of the Reformation, about 1490, and that was the time when Columbus, of course, discovered your your lovely country, or your lovely continent, I should say, and it was also the time when double entry bookkeeping was invented by the Italians. So we actually do have accounts of money, and by money we mean gold, that was passing through merchants' hands. So we do have reasonable estimates of the above ground stocks year by year by year. They became particularly detailed in the 1800s when you had a number of gold rushes. You had obviously California, you had the Klondike, you also had South and West Africa, and also Australia. So, but all that was documented, and the vast majority of the gold stocks above ground today have rarely been built up in the last 100 years. So the idea that it's double, no. The idea that the figure is accurate, equally wrong. But having said that, we can track I think a good 90% of the above ground stocks today. So I hope that puts rumours about an awful lot of stock above the ground to bed. Have a read of James Turk's work. I think it's very, very instructive.
Well, before we let you go and wrap up the show, Alasdair, do you have any closing words of advice for listeners as we head into this fall season?
Well, my experience of watching or dealing in equity markets for over all these years is that when a bear market starts, you have usually about sort of three phases. It may go on a bit longer than that. The first phase is a nasty shock, which is a sort of wake-up call. The second phase is a rally from that, which allows everybody to heave a sigh of relief. Now, if that's what we're in, don't just heave a sigh of relief. Just sort of think about whether you really want to stay with it or not, because if it is a proper bear market, the subsequent collapse will be extremely nasty. And if you don't believe me, just look at what happened in 1929 to 1932. And of course, there is another side of that, and that is that if we are facing that sort of environment, then I would expect the Fed, as we discussed earlier, to accelerate the production of new money. And that, I think, at some stage will undermine the purchasing power of the dollar and also all the other currencies, by the way, because they're all in the same boat. And on that basis, I think you'll find that the price of gold, even though in real terms gold may not go up, measured in dollars, my goodness, it would go up.
Yeah. The 1937 period as well, and the Great Depression has lessons for us today. I think we went through a period where.
The biggest lesson of all is that the government can't rescue you.
Yeah, and the illusion that pulling back on credit easy, and the calling in of gold and devaluation of the dollar by 75% or so in the banking holiday in the early part of the Great Depression, in fact, did create a huge counter force to the deflationary process of credit going bad. And that is kind of like where we may be in the not too distant future if we do have the mother of all QEs being launched. But just as in that period in the Great Depression, it didn't fix the problem, it's not going to fix the problem this time around. And if I'm right about the thesis of credit market participants finally getting religion, it's going to be really ugly, because the Fed will lose all tools with the exception of little trivial things like charging interest on deposits at the Federal Reserve, or the ultimate bombshell that they could drop in terms of their tools, and that's devaluing currencies against a reinitiated gold standard. And
yes.
That's a long way away, because the statists that run our Western economies want nothing to do with shackles of a gold standard, keeping their ability to, print at will and float welfare states, etc. They just don't want that. But that really is the end game that we're facing. And at some point, these machinations, these attempts of trying to fix the system with various tricks are all going to fail. It's just a question of when. And we're probably going to go down that road and see the ultimate return to trying to instill confidence by having a quasi-gold standard. Time will tell.
Time will tell. I think if I can have a final word, I hope none of this comes to pass. All I hope is that we return to sound money. Unfortunately, I think returning to sound money is a process of crisis first, sound money second.
Yeah, I mean, the powers that be will not relinquish that control and reversion back to sound money without being severely spanked. And that's
exactly
just where we are.
All right. Alasdair, always a pleasure to have you back with us.
My pleasure. My pleasure.
We highly recommend all of our listeners check out Alasdair's regular work over at Gold Money, market updates, as well as weekly analysis. Always excellent material. So one of our favorite guests, and it's always a treat and a pleasure to have him back on the show. So for this week's Metals and Markets, for Eric Dubin, the Doc, and Alasdair Macleod, thanks for tuning in to this week's SD Weekly Metals and Markets.